This is the formula of compound interest. Albert Einstein called it the eighth wonder of the world. And he said, whoever understands it earns it, and whoever does not understand it pays it. A fixed deposit is the easiest way to earn compound interest. But the question is it also the best compounding option for everyone? So today we will try to find out how FDs can be a great investing option for some people, while for others it could be loss-making. And we will not just be looking for which banks offer you the highest FD rates. Instead, we will try to find what is the right strategy for investing in FDs. Namaste and welcome to Retail Investing. So let's start with the example of an 18-year-old person and a 60-year-old person and try to find out what is the best and the easiest way for each of them to earn compound interest. This is Aditya. As the name suggests, he is radiant like the sun. He is only 18 years old, which means he has one thing in abundance. And that is time. Since most people work until they are 60 years old, Aditya has 42 years of time which he can trade for money. But right now, he has almost no money. If you look at the compound interest formula, you will notice that time is in the exponent, which makes it the most important component of wealth compounding. For Aditya, this number is huge, but his principal is very small now. And that is not a problem because it will keep increasing in the future as he starts a career. This is Sharmaji. He is 60 years old, just retired, and he is usually known for the great achievements of his son. And by the way, we are all forced to compete with Sharmaji's son. If you try to fit Sharmaji in the compound interest formula, his principal amount is huge, and that is because of all the money he has saved for retirement. But compared to Aditya, he has little time left, and that is one of the sad realities of life. So these two factors, that is the size of the principal and the amount of time left, which vary from person to person, makes it extremely important to set investing goals. The average life expectancy in India is just above 70 years. So that means we can assume that Sharmaji has only 10 years left and Aditya has 62 years left, considering the life expectancy increases by 10 years in the next 50 years. Based on this, Sharmaji's investing goal should be to preserve the wealth that he has created over the last few decades. And FD is a great option for him. It won't grow his money by much, but it can certainly preserve it and let him enjoy a carefree retired life. Now what if Sharmaji decides to be a little adventurous and chase higher returns? Well, he can consider investing into an index fund. So here is some data from 1999 to 2021. The Nifty 50 index has given approximately 12% annual returns in the last 15 years. No FD comes anywhere close. But when it comes to calculating returns, we must calculate the risk-adjusted returns. For someone in their 60s, volatility is a huge risk. You see, the Nifty may have given 12% annual returns in the last 15 years, but those are not consistent returns. Some years were extremely painful. For example, 2008 gave negative 51.3% returns and 2011 gave negative 24% returns. This is the chart of the American index S&P 500. It went through a lot of pain in the 1970s. The peak which it made in 1973 was not touched again in the next 7 years. It happened because of a global energy crisis and high inflation, and these events cannot be predicted. So Sharmaji's adventure of chasing higher returns can lead to a disaster. At the age of 60, he simply cannot afford to see his portfolio go down by 50% and not recover for years. Volatility is a huge risk for Sharmaji because he has less time left and he cannot wait for 5 years for the stock market to recover. And he should invest in those assets which won't make him lose sleep at night. Now if we talk about 18-year-old Aditya, the situation is completely opposite. Short-term volatility is not at all a risk for him because he has decades of time left. Making low returns is probably the biggest risk for him. And that takes us to the next concept. So let's say our 18-year-old dude Aditya has 50,000 rupees. He won it in a quiz competition. Aditya was introduced to the compound interest formula in his mathematics class when he was 10 years old. Being a bright student and understanding the power of compounding, he decides to invest that money instead of spending it. His option 1 is to put that money into an FD. The average interest rate he gets is 6.5%, and if he holds it until his retirement, his 50,000 will become 7 lakh rupees, and that is roughly 14 times his investment. But if he goes with option number 2, which is the index fund, he will get annual returns of 12%, and that will make his investment of 50,000 rupees become a whopping 58.36 lakh rupees, and that is 117 times his invested amount. So the opportunity cost for investing in FD is 51.36 lakh rupees, and that is more than 100 times his invested money. This looks like a loss-making investment for Aditya. Now, opportunity cost is usually calculated for different investing options within the same asset class. For example, the HDFC stock versus the TCS stock. They both belong to the class of equity, and FD gives us guaranteed and consistent returns, and stocks go up and down for no reason. So it's a bit unfair to compare them. But if you take any 20-year period, the index returns are almost guaranteed, and they are much higher than any FD. So this is the chart of the Nifty 50 index. So let's say you were unlucky and invested all your money in the index in 2008 when the market touched its peak of 6,300 levels. Even then, you would have recovered your money in the next 34 months or so. And if you held your investment for 9 years until 2017, you would have generated annual returns of 7%, which is more than FD returns. And if you held it until the present day when the Nifty is trading at 22,000 levels, your annual returns would be more than 8%. Now this was the worst case scenario, and people doing cost averaging in the index will get much higher returns in a 20-year period. So young people who have a long runway for earning and saving money should definitely consider index investing before FD investing. However, even for young people, FD investing is very important in a certain scenario, which I will discuss in a moment. But before that, let's discuss something very important. It's not like that the government decides the FD rates. Individual banks decide what their FD rates will be, and it varies from bank to bank. But does that mean that the banks have complete freedom over deciding the FD rates? Absolutely not. You see, the business model of the banks is quite simple. They borrow money from the public at a certain interest rate, which is the FD rate, and then they lend the money at higher interest rates in the form of home loans, car loans, etc. The difference is their profit. Now, when inflation goes high, the Reserve Bank increases the interest rates at which banks can borrow. So when banks borrow at higher rates, they will also have to lend at higher rates. This is the reason why we see that during times of high inflation, both FD rates and loan interest rates go up. And without much surprise, fixed deposits linked to the repo rate have already emerged. So we cannot say that it is completely up to the individual bank to decide its FD rates. They have to follow the macroeconomic realities to be in business. And by the way, when FD rates go up, it does not mean that you are getting higher returns. The inflation adjusted returns remain the same. Building an emergency fund is the scenario in which FD investing becomes important even for young people. There are two things which matter the most for an emergency fund. Firstly, the money should be invested in almost zero risk assets. We are not chasing returns here. And secondly, in times of need, we should be able to withdraw the money as easily as possible. Now imagine a small finance bank offering you 9.5% returns on an FD. The question is, why are they offering such high returns? It's simply because they won't get deposits from the public if they offer lower rates. And that's because they are not a trustworthy name yet. The big trustworthy banks will always offer you lower FD rates, and they can still increase their deposits. Now the second thing we discussed that matters is that how easily you can prematurely break an FD in case of an emergency. Are your personal relations with the bank very good? Are you sure that they will instantly let you withdraw without any harassment? If the answer to these questions is a resounding yes, then it's okay to do an FD in that small finance bank. But please remember that the size of deposits that small finance banks have compared to the large banks is very small. Their customer bases are small, and if a lot of people try to withdraw at the same time, the bank could get in trouble. So they definitely want to avoid a lot of withdrawal requests. Even today, FD investing is important, but it could be loss-making for you if you don't understand your investing goals, your time frame, and most importantly, your circle of competence. Make sure that investing in fixed deposits does not give you a fixed mindset. Learning about different asset classes, businesses, and expanding the circle of competence should be the goal of every investor. But as long as only FDs fall inside your circle of competence, it is okay to invest all your money in them. It's like making shorts is outside my circle of competence, so I am staying away from them. And by the way, our dude Aditya, his full name is Aditya Sharma, and he is the youngest son of Sharmaji. He will soon get into an IIT and there will be peer pressure on you. So young people, you better focus on physics and maths and let your money grow in an index fund, which does not require any effort. I will see you soon. Jai Hind.